Imagine your family waking up tomorrow and your income just vanished forever. How would they pay the bills, the mortgage, or even basic living expenses? This terrifying reality hits thousands of families every day. But there's one simple financial tool that can prevent this nightmare from happening to yours. Life insurance might sound complicated, but it's actually one of the most straightforward financial products you can buy. Think of it as a safety net contract between you and an insurance company. Here's how it works. You pay regular monthly or yearly payments called premiums, and in exchange, the insurance company promises to pay your chosen beneficiaries a lump sum of money if you pass away during the coverage period. The mechanics are surprisingly simple. When you apply, the insurance company evaluates your health and lifestyle to determine your risk level. This process, called underwriting, helps them decide how much coverage you qualify for and what you'll pay. Your premiums are divided into three parts: company expenses and profits, the actual cost of providing your death benefit, and if you have certain policy types, a savings component called cash value. The death benefit your beneficiaries receive is typically tax-free, which means if you have a $200,000 policy, your family gets the full amount without Uncle Sam taking a cut. This money can cover funeral expenses, replace lost income, pay off debts, or fund your children's education. Now, there are two main types of life insurance, and understanding the difference is crucial. Term life insurance is like renting coverage for a specific period, usually 20 or 30 years. It's much cheaper because it only pays out if you die during that term. If you outlive the policy, it expires worthless, but you've protected your family during your highest risk earning years. Permanent life insurance, particularly whole life insurance, covers you for your entire lifetime and includes a cash value component that grows over time. Think of it as combining insurance protection with a savings account. You can borrow against this cash value or even withdraw from it, but you'll pay significantly higher premiums for these additional benefits. The key question isn't whether you need life insurance, but how much. If people depend on your income or would struggle financially if you weren't around, you probably need coverage. Even stay-at-home parents should consider policies since childcare and household services cost thousands annually. A simple rule of thumb is multiplying your annual income by 10 and adding any major debts or future expenses like college costs. So if you earn $50,000 yearly, you might need around $500,000 in coverage. Remember, this information is for educational purposes only and shouldn't replace personalized financial advice from a qualified professional. Every situation is unique, and what works for one family might not work for another. Life insurance isn't about planning to die, it's about planning to live responsibly. It's one of the most loving gifts you can give your family, ensuring they're financially protected no matter what happens. Did this help clarify life insurance basics? Smash that like button if you found this valuable, and drop a comment sharing your biggest life insurance question. Don't forget to subscribe and hit the notification bell, because next week we're diving deep into exactly how much coverage you actually need with real examples and calculations you can use right now.